This obsession that every market participant and analyst and strategist and portfolio managers have over inflation and labor markets are not as useful in this market right now, given the fact that we depend so much on fiscal spending. The Fed is showing their cards of how constrained they are, how trapped they potentially are.
Hi, and welcome to Wealthion. I'm James Conner. My guest today is Tavi Costa, and Tavi is the macro strategist for Crescat Capital. And we're going to get his views on what the first of many interest rate cuts means to the economy, to inflation, and to the US dollar, and how we should reallocate capital in a falling interest rate environment. Tavi, thank you very much for joining us today. How are things in Denver?
Thanks for having me. Things in Denver are great and perfect weather, and here I am working at the office.
Yeah, I know. It's the same way in Toronto. I cannot get over this late summer that we're experiencing. The weather is just amazing.
Yeah, it's awesome.
So, Tavi, I want to start our conversation speaking on the economy. The Fed cut 50 basis points, as everyone knows, and thank God, because we've been talking about this for a year now, so they finally did it. And in December, we were expecting 6 interest rate cuts, and here we are in September, and we've only had 1. But you said recently in your commentary that you think this was a very aggressive policy change by the Fed. What do you mean by that?
Oh, it's a lot of unpack there, but the aggressiveness of the Fed policy shift, I think, has a lot to do. I mean, you can't really justify that on the data, in my view. There's not much of a tremendous weakness in the macro data to potentially drive that. I mean, potentially you can say that the labor markets are starting to show some cracks, but I think there's a lot of noise in that view as well, just because of immigration and other things. But I think the real change here, in my view, has to do with the interest rate payments that are clearly surging and starting to eat into fiscal spending. And as we see that occurring, I think that's going to be forcing more and more monetary policy to be driven by that, not in really constraining monetary policy to actually having to suppress the cost of debt to allow the government to spend more money. And so to me, that's what it comes down to. So I'm actually, I think, on the back of that view, you start developing other ideas, especially the weakness and the fragility of the US dollar, not only versus hard assets, but starting to sort of spread that weakness towards other fiat currencies, the Australian dollar, the Canadian dollar, even the Japanese yen recently, and the euro, that a lot of which I think it's completely out of consensus type of view, where most of the of market participants actually have a more bullish view on the dollar. So versus other fiat currencies. And so to me, that's a big takeaway. The Fed is showing their cards of how constrained they are, how trapped they potentially are. And that's going to have ramifications in the FX markets as well.
Right. So just to clarify or quantify what you're saying is the Fed has, or the U.S. government has $35 trillion in debt. The interest payments are about $1 trillion every year. It's the largest line item now in the budget, and that number is only going to grow. So you're saying the Fed is concerned about these interest payments growing every year, so therefore they're in a rush to cut rates now.
Yeah, and I think that the counter argument to the fact that you can make a create a view about the dollar, given that idea, is that other economies are also seeing the same issue. And I used to be of that view until I really dive into the idea of looking at interest payments relative to GDP across different economies. And the US is by far running the highest. We're approaching 4% when you include local governments. Other places in the world are actually running sub 2%, some places even sub 1%. And so the readjustment, I should say, that there's an inconsistency with the interest rate policy, even after the 50 basis points cut, relative to how much we're spending on the fiscal front. And so that inconsistency creates a sense of urgency of the Fed to move quicker than other economies, because the currency markets are really a relative game, as we all know. And so you have to think about how much will the Fed be likely to change their policy relative to other central banks. And I think that comes down to a very large potential for big changes here in the U.S. for further reductions in the interest rate of the Fed and relative to other places in the world. And so therefore why that view that fiat currencies outside of the dollar can actually start performing better than the actual dollar. And so this is all very linked. And the other aspect of this is, looking back throughout history and charts of, US break-even rates, which is one way that the market uses to analyze and have a view about where CPI will be 10 years from now, whatever the duration of the break-even rate really is. And you're looking at those charts, it clearly shows to me that we're actually forming a technical support in those charts. And that's, if you look at break-even rates in line with oil prices, they all tend to move very, very, very similarly. They're very connected. And so that, also creates a view about potentially inflation actually resurging, especially on the back of this rate cut that is more aggressive than, I would say most have expected. And so this is a big change in the macro landscape, in my opinion.
So let's talk about inflation now. Jamie Dimon spoke recently and he said he thinks inflation is still an issue and there's going to be more inflation on the horizon because of government spending. And he also expressed concerns with the possibility of stagflation, that is a slowing economy with higher inflation. Do you think the Fed is making a policy error by cutting rates too early?
A policy error would basically assume that they have a lot of options on the table. Like I said, if you're, let's think about this for a minute. Since the global financial crisis, and I'll give you some context before I answer that question. Since the global financial crisis, what has been one of the biggest beneficiaries that caused US markets to outperform any other place in the world? And I would argue, yeah, technology has been a big one, but even potentially even more important than that has been the fiscal exceptionalism we've seen in the US. This allowance of the US being able to spend more than other economies. In fact, if you look at the average of fiscal spending in the US all the way back to the global financial crisis, we approach close to 8% and annually. And the second one would be Japan. Japan is at about 5%. But Japan, majority of that spending is not pro-growth, right? That spending goes to entitlements and all those things. And believe it or not, in the US, that 8%, a large percentage of that actually goes to pro-growth policies, which creates growth economically versus other places in the world. And hence why you tend to see that premium on valuations versus other places in the world. Again, this is just my view of an analysis on the fiscal spending side. When you have interest payments now becoming 70% of the deficit, right? Now it becomes a problem. And the question really is, how do you adjust that? Do you lower fiscal spending or, to adjust the issue? Or do you actually adjust the interest rate aspect and suppress the cost of debt to allow the fiscal spending to be, to continue to be larger? Because if we don't see that, then it's going to start, that interest payment is going to start eating into the deficit. And by definition, if you don't increase the spending, then your actual spending that is pro-growth is going to be shrink. And so this is actually a critical problem. And so going back to your question now, I don't think the Fed has a lot of options. I think this obsession, I've been saying this for some time now, this obsession that every market participant and analyst and strategist and portfolio managers have over inflation and labor markets are not as useful in this market right now, given the fact that we depend so much on fiscal spending that if interest payments are really eating into that pro-growth spending, then we have to adjust that regardless of where inflation is, regardless of where labor markets is. And so this is why I am laser focused on that, because that suppression of cost to allow the government to spend more, has a lot of ramifications in other asset classes. So the steepener or the steepening of the yield curve could be another mechanism or another way of unleashing these policies. That could be potentially as well very another idea here in the macro side. And so there's all sorts of things outside of the dollar weakness. Emerging markets could do very well on that front. the reemergence of inflation. All these things to me are real, potential changes in the macro landscape.
So you just touched on the yield curve and you wrote about that recently, and you said the spread between the 2 year and the 10 year was altering, and you think this is something investors should pay attention to. Maybe you can just elaborate on this and why investors should be concerned with what's happening between the 2 and the 10 year.
Yeah, well, I created an indicator called the percentage of yield curve inversions, which looks at all the possible spreads in the yield curve, and then it calculates how many of those are inverted, and it looks back in history all the way to the 1970s, 60s, even 50s, depending on the chart we created. And in fact, IMF invited me to present about this indicator, because we've done a whole research of how this tends to be a recessionary signal, not the actual inversion, but the number of inversions in the curve, have an even better timing when it comes to predicting recessions than the actual single inversions that people tend to look at, the 2 versus 10s or others. And so, in my view, what you tend to see is the buildup of inversions, number one, and then this abrupt moment where the disinversion happens. That is usually kind of a classic, more recessionary indicator. Now, playing the recession game, you can play it in many ways. Now, a lot of people short the equity markets, and the other way to do this, if you have having issues having a view about the equity markets, one idea is to definitely look into more of the yield curve inversion or uninversion process. And so I am of the view that this uninversion process, or the steepening of the yield curve, is probably going to continue. Now, then the question becomes, a lot of people ask, is that a bull steepener? Is that a bear steepener? I don't really care, because, my view is that it will probably steepen. And I don't care if it's more on the 10 year versus the 2 year. Now, to address that question that a lot of people ask, a few months ago, I was of the view that the 2 year was going to be the one that would really drive that view, meaning the 2 year would fall much quicker than the 10 year would rise. Now I have flipped that view recently because of my views on energy, my views on inflation resurgence. I actually think that the 2 year yield needs a break. And what is likely to happen more and more in the following months is that the 10 year yield has a lot of room to grow much further. And so I am laser focused on that, because I think that that's in line with this view that inflation expectations is likely to bottom. Energy prices could start rising, and cyclical commodities in particular could benefit tremendously in this environment as well.
So what's the yield curve telling us right now about the economy, or more specifically, if the economy is in a recession or not?
It's not positive. It's not a positive signal. It's a very negative signal. And a lot of people trying to justify the yield curve steepening after being deeply inverted. I think that's very misleading. And I would, when you're an investor, you don't know how things will play out. So what you do is you kind of have a checklist of things that you pay attention to. And so this is one of them that I would put at the very top as a recession signal. If you're not paying attention to that, I'm not sure what you're doing. So that's a very critical one, especially given how valuations are. You can look at valuations on the CAPE ratio, and now, on top of that, being in such an overvalued equity market, and you also have steepening of the yield curve from very deeply inverted levels, and one of the longest inversions we've seen in history, which I think only adds to the case that we're going to see an even, more abrupt uninversion process. It all really adds to that case in a big way. And no, don't forget what we're seeing in terms of the 50 basis points of a cut in the interest rates. Although I have a view on interest payments and all that, when was the last time we've seen this, a 50 basis points cut? I mean, in the last 30 years or so, or since the 1990s, all of these 50 basis point cuts actually happen, either preceded or coincided with recessions. And so that's also, a real problem, because there has been a lot of discussions in the macro community if this is sort of a mid-cycle soft lending or something along those lines, like we saw in the mid 90s. The mid 90s, actually, we did see that. But the mid 90s, the interest rate cut that we saw from the Fed was only 25 basis points, was never 50 basis points. So this is definitely a change. And I think it plays more negatively in this. I also would point out to other things that could potentially be more negative for the economy have to do with the consumer. If you look at the one example that anybody can look into, and that I think it's a very interesting perspective, is looking at the auto market. When you have a car loan, look at the divergence between two interest rates: the 5-year yield by the U.S. government, which is basically a risk-free rate by 5 years, and secondly, look at the car loan rate. Or in other words, how much a lender in the auto space is offering in terms of interest rates out there. And what you're going to find is that we've seen the 5-year yield fall recently, but if you're actually trying to purchase a car, those lenders are still charging you a much higher interest rate. Why is that? Why is that not following, which historically tends to follow? Do you know the only times that divergence happens is in recessions? And that's because from a lender's perspective, they are seeing that the consumer is not as positive or as healthy, and therefore they keep their interest rates slightly higher. So I pay real close attention to these signs, because I think that they tell you a lot about the health of the consumer. So if the lender is not willing to take the risk to lower their interest rate to match the falling 5-year yield on the risk-free rate, then that means that their perspective about the consumer has changed. And so that's something I pay very, very close attention to.
Yeah, interesting points. And I got to say, I want to digress right now because I just bought a new car recently, and I always hate going and buying a new car because I feel like I'm getting screwed over by the dealer.
Yeah.
But you mentioned you were talking about the Fed. They cut 50 basis points, and you were quite surprised by that. Do you think that they see something on the horizon, a potential problem that maybe just showed up here in the last month, and that's why they were so aggressive? Or do you think maybe they just said, okay, let's cut 50 points and let's wait until January before we do it again?
Look, I've been calling for, and this has been my mistake as a strategist, as a portfolio manager, as an investor myself. I've been very concerned about U.S. equity markets for some time now. That's full disclosure on that view. Been very bullish commodities, very bullish hard assets, very bullish emerging markets, and other things that have worked as well. And so, to me, this is it's a tough one. I do think there are, when I look at my checklist, I see a lot of issues. Now, when I try to look at the economy from the Fed's lenses, meaning inflation or labor markets, I think inflation, there has been some progress on that front that justifies the rate cuts, but not massively. I mean, if anything, look at what's happening today. I mean, the Fed, if the Fed is just saying that, we want inflation, the inflation war. I mean, look at what commodities are doing right now. They're surging in prices. And so does that mean we killed inflation? Probably not. And that's because structurally, the commodities trade or the inflation problem is still here with us. We still have deglobalization trends intensifying. We still have the underinvestment in the commodities industries. And all these things are going to still, cause the commodity space to be constrained on the supply front. And every now and then we'll see commodities actually rotating on the upside. And so all these things to me is the concern. So I don't think the picture, to answer your question, I don't think the picture has really shifted from the economy front. And I still see the economy very fragile. And maybe the Fed is seeing something worse than the markets are seeing and investors are seeing. I think that's a possibility, sure. But if anything, I do think that what's happening is especially coming from senators now writing letters to the Fed to cut interest rates, basically forcing the Fed's hand to actually act on a political front and start cutting interest rates so it doesn't kill the economy. So To me, it really goes back to the fiscal spending side. I think that the fiscal spending is such an important aspect of this economy. And I imagine the economy has so many issues and so many, and some other aspects that are still positive. But think about if we just take it away, all the fiscal spending. Now, where would we be? We're now spending in terms of the deficit close to over 7%. If you add the trade balance aspect, we're running a 10% twin deficit, meaning trade balance is negative and the fiscal is also very negative. No, it's okay. I mean, if you're reserve currency, you want to run a twin deficit, but not a 10%. If you're running 10% all the time, of course, that's going to have an impact, a very negative impact in your currency. And so this is why, again, it goes back to that dollar idea. And so, I'm definitely concerned about the economy. It's just it's such a difficult view to have in markets because it's just been delaying for so long. All these signals that have been lining up for a recession and it hasn't happened. But I don't think that the fact that we haven't seen one really changed the probability of one happening. In fact, I think it only adds to the case.
This show is sponsored by BetterHelp. It's finally happened and was only 4 years in the making. The Fed has cut rates by 50 basis points. Yes, it was a little surprising, but maybe they see bumps in the economic road going forward. And maybe there are bumps in your personal economic road that are weighing on you. Or maybe there are other things that are on your mind, keeping you from thinking about all the good things in your life. It happens to all of us. We walk around with the weight of the world on our shoulders and look at others thinking their lives are perfect with no worries or cares in the world. Everyone has worries and things they think about all the time. You can't let those things get in the way of the fun things you want to do and explore, or the things you're curious about and want to tackle. It's why I speak to someone. It helps to ease some of the negative thoughts and gain a new perspective on some of the things that are floating around in my head. And believe me, there's plenty. If you need to talk to a professional or are thinking about giving therapy a try, give BetterHelp a try. It's easy, online, convenient, and flexible to fit your schedule. Just fill out the questionnaire, get matched to a licensed therapist anytime. Rediscover your curiosity with BetterHelp. Visit betterhelp.com/Wealthion to get 10% off your first month. That's BetterHelp, HELP.com/Wealthion.
Yes, I have also taken a very defensive view in the last couple of years, and it's cost me a lot in terms of performance. But once again, it comes back to the point that you made about fiscal spending and spending trillions of dollars. When the government's spending that kind of money, of course, assets are going to get inflated. So let's talk about market valuations. And we had a pullback in early August, which was followed by a very nice rally. We've seen a little bit of volatility here in the last couple of weeks, but the S&P is up 20% on the year. The NASDAQ's up 20% on the year. NVIDIA, I got to mention that one, it's up 140% on the year. And you have written extensively about equity valuations, and you also compared this time period to the tech bubble of the early 2000s. Maybe you can just elaborate on that.
Yeah, definitely. I think valuations have been very frothy in today's markets, and more broadly speaking, it's not just it's not just a technology space. Although technology has been certainly leading a lot of that capital flows and causing valuations to be so inflated. But there are other things inside of the economy that I think look, in my view, problematic. Now, let's talk about the consumer discretionary picture. How much leverage today in most consumer discretionary companies have versus other times in history. It's one of the largest debt assets ratios we've seen in history of that sector. And, looking at the valuation itself, of most companies, trading, a crazy multiples from a revenue and the bottom line standpoint as well. It concerned me quite a lot, especially when you also know that foreign investors have already, piled on U.S. equities for too many years, for too many decades now, and understanding that leadership in markets changes every couple decades, meaning you have U.S. markets leading the way and then turns into emerging markets lead the way, which causes commodities to do very well. And so I think we're kind of in this turning point that doesn't happen all at once. You kind of have lots of signs of things, and then things start kind of taking shape. And that's why emerging markets, some of them have been doing well already outside of China, especially the resource driven ones. And then you tend to see some resource companies doing very well as well on the back of that. And so I think these are all kind of trends unleashing. They haven't fully unleashed, but they're unleashing. You can see that in the currency markets as well. British pound broke a major historical downward trend, and now potentially starting an upward trend. I mean, the British pound. I mean, that's probably one of the most hated currencies in the last few years. Same thing happened with the Japanese yen. What if this is the beginning of a trend? If you look at those charts over 20, 30 years, it certainly looks to me like we could be actually at the very beginning of a movement. And this is completely out of consensus view. So all these things to me are very interesting. I think that they play into the equity markets again, because the equity markets have benefited tremendously from these flows in the US dollar. The fact that we had all this, exceptionalism from the government spending side in the US relative to other places. And as we see these things shifting and the interest payments kind of eating into fiscal spending, I think that that's going to also have ramifications in equity markets, and that divergence of the premium that you have on a business being run in the US versus a business being run in, say, Brazil or some other country. I think that's going to close that gap slightly more. That means opportunity on one side, that means risk on the other side as well. So yeah, I'm very concerned about valuations in the US, especially if you're of the view that I am, that 10-year yields could be rising here. And I think that could be actually, if long-term yields start rising, that can also be a very important aspect. And notice the fact that utilities as a sector have been leading the market this year. I mean, that's the most defensive sector of the overall economy. Why are they leading? Is that because we're seeing too much spending on data centers and electricity consumption, and all those things are causing utilities to rise? Or is this a signal that the economy is not doing as well, and potentially it's just because it's most defensive sector that is starting to attract all the money? I guess you can answer both ways, but if it is because of electricity consumption, if it is because of spending in data centers, is there anything more bullish for commodities than that? I don't know. I don't think so. So that to me is also very attractive from a hard assets standpoint. So you can see how I'm tying up things together here. But yeah, I think that the time to be bullish in tech and bullish in U.S. equities was a decade or so ago, not now.
So we only have 10 days to go before the end of the quarter. It's going to be very interesting to see what we hear from a number of companies, especially the ones focused on consumers, and what they're saying about the health of the consumer. In Q2, we saw a lot of companies, including Amazon, Nike, Starbucks, McDonald's, so many more, all said that the consumer was under pressure. And it's going to be interesting to see what they say for Q3.
Yeah, I mean, the consumer companies or consumer discretionary companies are certainly a segment of the market that I am paying close attention to. The restaurants and others. Back in the COVID times, or a little bit before that, actually, what you saw was that most of these companies levered up massively. Some of them went from having very small amounts of debt to 60-70% of leverage all of a sudden. And so now these companies are all having to roll their debt. And as we all know, interest rates are much higher than they were 2-3 years ago. And so these companies have to roll their debt much higher now. And that's going to start creeping into and this is why tightening of monetary conditions works with a lag, is because when you raise interest rates, for a year or two, that doesn't really reflect in the markets just yet, because all these companies have locked in interest rates from a few years ago. And so until they start rolling their debt, you start seeing those issues, come into the market. So I pay close attention to leverage right now. I think balance sheets are going to be key here moving forward because of where cost of capital is. forget about 50 basis points interest rate cut. It doesn't really change the picture from, if you're running a business and you have to, and you're borrowing capital, call it, 3-4% not too long ago, and now you're borrowing at close to 10%. That changes your capital structure in a big way. So and eats into your margin, as we see interest rates and interest payments as well starting to hurt companies, corporations, and so all these things are important. So I'm paying close attention to this as well.
So let's talk about commodities, because you mentioned oil a couple of times, and oil, I believe oil's flat on the year. A lot of the stocks are down on the year. And what's your thesis on oil, and why do you like it?
Definitely building a conviction in the oil idea. Started with natural gas, looking at what's called the BTU spread, looking at the oil price versus the natural gas price and adjusting that by the BTU scale. And you find there is, things are really historically have not been that way in a very long time, which makes me very bullish in natural gas to begin with. So started building that position first. Also looked at the contango in the natural gas market, which shows that we have a very, very steep contango, which means that the further contracts are much higher than the closer contracts in the future markets. And so that sort of, looking back in history, when you have steep contangos, it tends to mark a bottom in markets. And so yes, those are things that are very interesting from a macro standpoint. And natural gas has been demolished and nobody cares about it. Everybody thinks it's gone, and we have too much supply of it. And I think that most of those things already reflect the price, in my view. And so that's one thing. The second thing is I start looking at oil itself a little more. I think a lot of people have realized that too, the correlation between that and US break-even rates, which is the inflation expectation chart. And you can see that if you were of the view that inflation is starting to form a bottom after, we saw a big surge of inflation, and then we kind of saw this consolidating period now. And the same thing is happening with oil. Oil was in a very, downward trend all the way back to 08 or so. And, it been hitting a resistance. Then back in 2021, after elections in 2020, we saw a surge in oil prices. And then after the oil prices kind of broke that downward trend, we've been kind of consolidating since then. And you look at positioning. So the future markets offer great, CFTC positioning. You can see that, it's one of the lowest amounts of long positions that we've seen in the last 2 decades. And so that adds to the case. It kind of sets the stage for a reversal in the trend of energy prices in a big way. Those are the main reasons why I have, I'm forming a strong view in the oil space. And I think that this whole idea that elections have an impact on oil prices is totally overplayed. The drilling. I mean, I guess if there was something to learn about the debates that we heard recently, was that what Kamala said, how many times that she's going to be drilling, and it's going to be promoting production, and I think that even that didn't cause oil prices to really move, and maybe that's just the market not agreeing or not believing that that's going to come true. But my views is that those things are really overplayed. They're kind of hiding the opportunity. The opportunity is that geopolitically the risks are there, that things can actually get more and more disrupted, and if that happens, I think oil can trade a lot higher. So it wouldn't surprise me at all to see big changes in oil prices like we saw in the past. And I think that volatility suppression in the oil market is short-lived. And so I'm of the view that we can see big spikes in oil prices that can change the dynamics of inflation.
Big spikes like how high? It's currently trading around $70 a barrel.
I would love to tell you the answer, but I can't, for compliance reasons. I can't tell you target prices, unfortunately. I can say, I can tell you that I do think that oil prices are very cheap, it wouldn't shock me to see numbers that we saw in the recent prior peak. which was trading at $130 a barrel or so.
So if I take the other side of that argument, we got a slowdown in the US economy. We got a slowdown in China, the two largest economies in the world. How do you make a bullish case for oil?
Well, I think the other side, which is everyone and their mother, also have been making that case. It's funny, I had a chart showing, when oil was trading at $130 a barrel, everybody was knocking on the door and saying, I'm bullish, I'm bullish. And now that the oil is at 70, 60 plus, everybody's like, no, I won't touch it. And, that's normal. That's sentiment right there for you. And I take to heart what happened in the 1970s, because I think this is a very similar environment where inflation is highly embedded in the system. And actually, the rise of during that time, what we saw was that the economy was not doing very well, but energy prices were going up. And so there was a correlation that changed in that period where when inflation reemerged, the market didn't like that, because obviously that means that the Fed had to do more in terms of reacting towards the inflation problem. So, we can debate how that would play out today because of the debt problem, because of the interest rate, payment surge that we're seeing and all that. And I think that those are very important discussions. But I think that what we can see here is the bottoming of especially inflation that can actually become or create a more stagflationary environment later on. And so, the weakness, ultimately you tend to see that later on, that the slowdown of the economy should cause markets in the oil space to react the other way. But, it's funny that oil markets have already reflected a hard landing, while equity markets are reflecting what? That's not a hard landing. That's, it's everybody's party. And so, I'm of the view that the oil markets already made that move for us. And so, if anything, I'm not saying we're going all in on this idea at all, but I can tell you that the positioning is off balance, historically speaking, with data. And so at times like that, when you have a view about where the constraints are in terms of supply, and on top of it, the correlation of that and deglobalization trends that continue to manifest themselves in globally, deglobalization. And I think that could have an impact on oil prices here soon.
Yeah, you made mention of the fact when it went to 125, 130 a barrel. And I recall in Q1 of 2020 when it went down to $25 a barrel, and everybody was saying, that's it, we don't need oil anymore. It's going to zero. And it's, I guess your analysis, it's the same sort of thing. You're looking at it from a contrarian point of view.
Yeah. Now, I'm not I love when you're able to find an asset that already reflects a negative story, and you have enough contrarian points to take the other side of that idea. And there are not many things like that today. And I think oil is one of them. Natural gas. I mean, there's some regions where natural gas is being sold at negative prices right now, just like that period you just mentioned where oil prices went negative in 2020. And so it's normal, I was showing a chart the other day of the gold, not to digress as well, but there was a good chart that I was showing from gold miners relative to gold, which for 30, 40 years have been only going lower. And recently we've been forming a bottom, and looks to me like the miners are starting to outperform gold itself. And that's just such a, nobody believes in it, right? Because everybody has been hurt so many times trying to take that view that it's just normal. It's plausible to see people be very skeptical about that. Normal. But clearly on the data, we've been forming a bottom. And so, it's interesting how, every time I post that chart, people say, oh, I'd rather see, further confirmation first. And, that's the difference between buying something cheap and buying something more expensive. You have to have that mentality, and I think that's in your gene or not, to be able to have conviction to act on something that is very cheap. So, and sometimes things are always cheap for a reason. There's understanding that risk you're taking is absolutely critical in that when you're taking a contrarian view on something in the markets.
So let's talk about gold. You and your team have done a lot of work on gold and gold equities. And what are your views on gold in a falling interest rate environment like we're experiencing right now?
Oh boy, we're in such a pivotal moment for the gold space because we're finally seeing, acquisitions and mergers happen in the space. It's something that usually marks a big change in a cycle for this industry. We're finally we're still seeing production falling apart for most of the majors, meaning it's not like they're producing more. Barrick is the second largest gold miner in the world, and they're still their production is the lowest in 20 years. They've been shifting their focus from gold to copper. That's basically the narrative across most of the major companies is that, this is reflecting as well in the multiples of a project. If you're trying to buy a project, a gold only project, that doesn't have any copper, that has a lower valuation than a copper and gold project. And that's because there is institutional capital chasing battery metals, electrification metals, and other things. And so you tend to see that reflecting on the valuation of those projects. And so I am of the view that the gold space in particular is a legacy space. It's a place that's been there for many decades, and now we're seeing sort of a secular upward trend on the price of gold, in my opinion, that can create a big driver for fundamentally for these companies that remain with multiples that are, I think, reflecting no growth whatsoever. And so that's key. When you find something that has compressed multiples with, very significant growth drivers that can be expanding those multiples in a big way. And so I love that space, and I think that space offers one of the most inefficient segments of the market that I've ever seen. And inefficiency is a code word for opportunity a lot of times in the investment world. And so I've been I think that this industry is poised to perform very well in the following decade. And so the way we've been playing this is, obviously there's producers, developers, and explorers. The explorers look to me very interesting because, again, the more you go to the early stages, you tend to see more geology expertise driving the valuation of these companies. And the reason that we have a lack of geologists, especially mining geologists, because majority of the geologists have been going to the oil space because it pays better. But overall, geosciences have been out of favor. Everybody wants to be a technologist, and so nobody is entering the geology industry. And so what you see there as a reflection of that is that inefficiency in markets in the exploration segment. And so we've been accumulating assets there that we think are high quality, that have intrinsically improved their probabilities of finding major discoveries, but are being priced as total failures. And so it's almost like call options. You're accumulating those call options and seeing, which one could potentially become a unicorn. In other words, having a major discovery that becomes a multi-billion or billion-dollar company. And so to me, that's, sort of that venture capital approach and mentality applies very well in this industry. And I would say that the other way that is also very attractive is that what I mentioned about some of these projects, they get out of favor. Now, the narrative always shifts, and you have to be disciplined so you don't get into those narratives. And the new narrative, as I said, is we want copper, we want cobalt, we want zinc, and all that. But the gold only space looks really attractive to me, particularly those companies, the larger companies that are selling projects for different reasons. Maybe because they're tier 2 assets, maybe because they just want to be more in the copper space or whatever that is. And so when you find those gold only projects, they're very attractive right now. And so especially if you take them privately, given the fact that the market is still fundamentally broken and it's not really given awarding companies that have high quality assets in the mining industry. But I think that's going to change. I think we'll see those changes. We just have to be patient And so I've been an accumulator of assets that I perceive as high quality.
I can't believe Barrick is the second largest producer in the world and their production has been declining for 20 years. That's
Well,
shocking.
it is shocking, and not to be a downer, but Barrick is the image of this industry in a lot of ways, right? And it's an iconic firm, and not to be, I don't want to cause disruptions here, but when you look at the performance, and I'm saying this because I want other people to do it. I've done it, and I know how it looks like. But look at the performance of Barrick relative to the overall industry. What do you see? I mean, this company has been underperforming, and it's not like the industry has been doing well. We all know this industry has been doing terrible. Now, look at the miners versus gold ratio. Boy, down what, 40 years? 30 years, just a total decline. Take a look at the Barrick to the overall industry index, GDX, GDXJ. You can take the XAU index, which is the Philadelphia index. A lot of people use it. Look at the Barrick relative performance versus that. What do you see? 30-year decline. And so in any other industry, you would have seen an activist come in and say, we're going to clean this up. I mean, who is leading this? Nobody's leading this. This is a mess, right? That's what you tend to see in the back of those things in any other industry. But in the mining space, it's been so forgotten, neglected, that people look at these things and they think this is normal. It's not normal. This is not the face of the industry. They lack vision. We need people that with vision. We need to form the new majors. Again, I'm not here to bash on anybody, but I think leadership is key in this industry, and the market is starting to really. This is the time to be taking leverage, right? And as a producer, if you're a producer, your focus shouldn't be on returning capital to shareholders. We're not in a recession for mining. Your focus should be on growth. Your focus should be on resource growth, and you should be laser focused on that. And so I think that I'm not sure how to change the industry like that. So I guess pointing out those things is important, and hoping that somebody else wants to take the lead on that, because I'm not willing to go on the fight with Barrick and change management and all that. I think that's a conversation for somebody else. But I'm willing to say that there's something wrong. And if you're seeing that performance the way in any other industry, that CEO would have been gone. So
And maybe that's what's going to happen. We're going to get an activist involved because they're going to look at the cash flow. They're going to look at dividends and just the future potential. And maybe somebody else does get involved at some point.
If you know where you heard it first. So, I think this requires a change. Fortunately, I've got time with other things, but yeah, like who needs to be the new leader of company like that? We need somebody to take the lead here.
And once again, your thesis for gold is interest rates are going lower. That's going to result in a lower US dollar and therefore higher gold.
My thesis for gold, I think there's a lot of things here. My thesis for gold is long-term, 5-10 years, and I'm not a gold bug. In 10 years from now, if mining stocks do what I think they will do, I could change my view. And 10 years from now, I could be doing something else with my life instead of, spending all this time with mining. I think gold is in a secular bull market. I think central banks are just starting to buy gold. I presented many charts that show that central banks, as a percentage of their assets, now own less than 20% of gold relative to treasuries and other fixed income instruments. And they're just in the process of accumulating those gold. And back in the 70s, used to be 70% of their balance sheet assets. So if you calculate those things and you think about the probabilities here on the central bank front, there's a lot of upside potential on the demand front for gold. So I'm extremely bullish gold. I think we could see much higher prices. And then if you study gold prices, you know that other metals tend to follow. So, we try to be cute and talk about cyclicality on the copper side and other things. But if gold goes up, and this is a secular bull market for gold, indeed, and then then copper will probably follow and do the same. And other things too, zinc, and you have cobalt, manganese, all sorts of things that can do very well. Silver, is potentially an even bigger, beneficiary of something like that. So yeah, all my views. But then near term, three, no, call it, I think more. A lot of people think it's more longer term, but call it 1 to 3 years. I think that the dollar is in real trouble. If you ask me what are you most worried about, the US dollar. I don't think it's the end of the dollar as a reserve currency. I'm not going that far. I'm a macro guy. I'm not not trying to be to make headlines saying that this is the end of the dollar. No, I'm just saying that the dollar would be, I think, under pressure because of the sense of urgency of the Fed having to act more than other central banks. That will have an impact in interest rates and ultimately should drive the dollar lower versus other places. And then the positioning is really off. And when we see that positioning coming back, I think will actually trigger a major breakout for most currencies that are kind of in the brink of that breakout. And once we see that, I think it's going to gain momentum. And so, yeah, I'm very bullish in other currencies versus the dollar, which I think adds to the gold case in the near term as well.
All very interesting points. And I want to thank you very much for spending time with us today. And if somebody would like to follow you or learn more about Crescat Capital, where can they go?
They can go to Crescat.net as a website, and they can also go to Twitter. Tavi Costa is my handle. And there you can also find me on LinkedIn. I post a lot of things on LinkedIn. Just look for my name, Tavi Costa, and you'll find a bunch of my posts almost daily that I share some of my views.
I'm a follower, by the way.
Well, thank you very much.
Tavi, once again, thank you.
Thank you.
Well, I hope you enjoyed that conversation with Tavi Costa on the economy. As Tavi mentioned, he's very bullish on the gold price. And if you would like to learn more about gold and how gold can benefit your portfolio during these uncertain times, visit our sister company, hardassets.alliance.com. Hard Assets Alliance is a trusted platform that's being used by over 100,000 institutional and retail investors to buy and sell gold bullion and gold coins. Once again, that's hardassets.alliance.com. There's a link below in the show notes. I want to thank you very much for being with us today, and I look forward to seeing you again soon.